Hi, Chapter 10, some lessons from capital market history. So if you look at the market, capital market, usually starting early 20th century, there are two key lessons. One, there is a reward for bearing the risk. Means that market gives a return for taking the risk. Number two, the greater the potential reward, the greater the risk. It means that if you take higher risk, then you can expect higher returns. So risk, the amount of risk you take and the amount of return you expect are positively related. So we also call there's no free lunch in the market. So before looking at the history, let's learn how to calculate the returns. There are two different types of returns. One is the dollar return, the other is percent returns. So the dollar return is the amount of dollars you make. So if you invest in stock, for example, there are two different types of the returns, cash flow you will receive, as you saw in Chapter 7. The first one is the dividend, the other is capital gain. Dividend is the amount of dividend the company pay, and the capital gain is actually the price difference. So if the price is increased, then you have positive capital gain, usually just called the capital gain. And if the price decreases, then you actually have the capital loss or negative capital gain. So basically you can just call capital loss. So the capital gain is the price received minus price paid. Now the second one is the percent return. Is now because this dollar return only gives you the amount of dollars. Now we want to know the relative returns, to the money that we invested actually. So it's simple. The percent return is the dollar return divided by the dollar invested. So let's look at the mathematical now. The dividend, the return from dividend is called the dividend yield. And dividend yield is the dividend next period divided by the dollar you invested. And the next return is the capital gain yield, which is the yield, the return from capital gain. This is the price changes, right? Divided by the dollar you invested. So the total percent return includes two factors. One is the dividend yield, the other is capital gain yield. And dividend yield is from the dividend here, and capital gain yield from here. So there are two factors. So let's look at the example. How to calculate the dollar return and the percent returns. So you invest in a stock with share price $25. And after 1 year, the stock price per share is $35. Each share pay $2 dividend. What is your total returns? So you receive what? $2 dividend, right? So dollar return $2 for dividend. And the capital gain is what? The price next 1 year later is 35, and price you invested is 25, so you make $10. So you make $12 total. That's total dollar returns. How about percentage? Now the dividend $2, and then you invested $25, right? So which is 8%. Now the second factor is the capital gain $10 divided by 25, again the dollar you invested, which is 40%. So total is 2 plus 10, which is total return 12, divided by again 25, which is 48%. So that's how to calculate the return. Now let's look at the graph from historical record. These graphs assume that if you invest in $1 in each asset class, how much dollars you're going to receive in 2008. So this is $1. Now, inflation, the price level increased by 11.73. If you're investing in all your assets in T-bill, then it's going to be $20.51. So it's about 20 times. Now, how about the long-term government bond? Now, it's actually 100 times, $99.16. Large company stock is tremendously a lot higher. It's about $2,049. And then small company stock is almost $10,000. It's about $9,548. It means that you're basically investing in different type of assets, right? And after 80 years, if you're investing in small cap stock, then you're gonna get $9,500 versus T-bill $20. So small cap stock gives highest returns. T-bill lowest returns. However, if you remember the risk-return trade-off, now let's look at the risk. If you look at this graph, there's some point that we actually can see this point, like the volatile points. And if you drop the price, and if you look at the small cap and large cap stock, and look at the small cap. The small cap stock, it changed a lot. It dropped like 90% decrease, and then bounced back. However, T-bill, it doesn't decrease. So T-bill is more stable, small cap stock pretty volatile, and the volatility here is actually the representation of the risk. So the graph showed that, well, the small cap stock gives the highest returns, the T-bill gives the lowest return, but small cap stock also carries the highest risk, and T-bill carries lowest risk. And in fact, for T-bill, we think that this T-bill rate is the risk-free rate. And US T-bill rate is the only risk-free rate in the world. So this is risk-free rate. Because United States governments will not be on default on the short-term debt. And these type of asset class, there is different type, different level of return you can expect, and also there is different level of risk you have to take. So some people may ask, well, from this lesson, I want to invest all my assets to short-term, small cap stocks, because I want to make a lot of money. In fact, that may be true if you're investing in all your wealth for 83 years. However, because you may live here, or here. If the price drops, then you actually suffer more. That's the risk. So you actually have to take that risk, and you have to be ready for taking those amount of risk to expect high return. So if you don't want to take the risk, then you just buy T-bill and you never lose your money. So this is the bar graph for large company stock returns, year to year. And if you look at here, this is the negative one and positive one. You have more positive, but you have some negative one too, right? And the range is about nearly 40 to 60%. Comparing with long-term government bond, which is less risky than the large cap stock, you have less negative, and the range is a lot narrower, so it's less volatile. But in fact, you actually can expect less return to lower return too. Now T-bill, you never lose money. There's no losing. And then you always make money, but the range is pretty narrow and the expected return is pretty low. So again, there's no free lunch. The market gives only the return that you actually, the amount, as the amount of the risk you take. This is again the average return for each asset class, and if you look at the small stock, it's about 16.4% per year, and the other in US T-bill 3.8%. So how to compute this historical average returns is pretty simple. The numerator here is just you actually just summing the you sum annual return, all of your annual return. For this example is 83 years. So 83 returns, just the sum of them, and divide by number of years, which is 83 years here. So if you're using the data in table 10.1 that we saw, the large company stock 11.7% means that the numerator, the sum of all return is 9.71 divided by 83 years. So it means that your best guess about the size of the return for the year selected random is 11.7%. It means that so you have next year, you want to invest in large company stock. The best guess you can get, on average, is about 11.7%. That's what it means. Now, there is the concept called the risk premium. The risk premium is simply the return, expected return on asset I minus risk-free rate. It means that this is the amount of the returns that you actually receive for taking the risk. The risk-free rate is the reward for time. So if you delay the consumptions, you actually expect some compensation. That's risk-free rate. And then the additional one, the difference here, is actually the reward for taking additional risk. So what is the risk-free rate? That's the rate on the risk-less investment, which is actually US T-bill, Treasury bill, short-term US government debt. And T-bill is the only risk-free asset in the world again. Again, risk premiums access return the risk asset over the risk-free rate, which means that this is additional amount of the returns for compensating to take the risk. So what is the historical risk premium? Now, let's look at just one example here. So let's go back here and look at the small cap stock, 16.4%. Right, so it's 16.4% small cap stock minus, I believe the risk-free rate is 3.8%, right? USTB rate, 3.8%. So it's going to be what? 12.6%. That's the risk premium, and that's the amount of return that you can get for taking the risk of this small company stock. What about T-bill itself? T-bill itself, the risk premium is 0 because there's no risk you take. So there's no reward for taking any risk. So this is the dispersion spread volatility of the returns. This is percentage, of the volatilities, and you basically just draw the bar graph, and the shape of the return, the volatility is like this, right? So how to measure it? We use the variance and standard deviation to measure the risk. So variance is kind of the common measure of the return dispersion. Is actually just sum of the square deviation from the mean, from the average, divided by n-1. And then because the variance is squared units, we just take a square root to get a standard deviation. And standard deviation actually just the same unit as the average. So how to compute? Let's compute that. If you have 5 return, 1%, 2%, 3%, 4%, 5%, 5-year returns. Calculate the average and calculate the standard deviation, and it's basically to get a. So let's alpha equals to average is 1% plus 2% plus 3% plus 4% plus 5% divided by number of years 5, right? you should have 3%. That's the mean, the average. Then the variance is now, the variance of this R equals to, the numerator is kind of long. Now the first observation is 1%, so 1% minus the 3% square, the mean, plus 2% again, minus 3% square, plus 3% minus 3% square, plus 4% minus 3% square, plus 5% minus 3% square. That's the numerator. Okay, divide by n minus 1, 5 minus 1. If you calculate this, you're going to have 0.0004 plus 0.0001 plus 0.0001 plus 0.0004 divided by 4, right? Then it's going to be 0.001 divided by 4, which is 0.00025, right? That's the variance. And then the standard deviation is the square root of the variance, 0.00025, and you can get it. So how much is that? It's going to be 1.58%. So that's how to compute the variance and standard deviation. Now this is the historical average of return and standard deviation, and you see the distribution here. This distribution looks like this, right? Small cap stop and long-term government bond, corporate bond, government bond, and intermediate, and T-bill, and inflation. And if you look at this graph pretty much like the bell shape, but this one like it spread more. That's actually higher risk. You see the T-bill is pretty narrow and lowest risk. So this bell-shaped curve is called the normal distribution. This is called the normal distribution. This is symmetric distribution, 50% and 50%. This bell-shaped curve, symmetric, exactly same. And the beauty of normal distribution is we can completely describe this normal distribution by mean and variance. It means that the average and standard deviation. So let's look at the example here. This is return on the large company stock. Now this is the average, 11.7%. Now I believe the standard deviation, so the average is 11.7%. And the standard deviation is now here, how much is that? (20.5%). Okay. So this is the average, and then you go to one standard deviation, so minus one standard deviation plus one standard deviation, so it's going to be between the negative 8.9% and 32.3%, right? So this is 20.5%, this is 20.5%, and this area is actually about 68% of this the distribution. So it means that if you pick any here randomly, now we actually explain this type of this type of return expectation using the average, on the average, the best guess. But now we have more probability stuff. So we have 68% probability that your returns will be between this negative 8.9% and 32.3%. Let's go to one more standard deviation. Now another 20.5% here, another 20.5%, and the range is between negative 29.5 and 52.9%. And now this area is what? 95%. 2 standard deviation. So it means that there's 95% probability that your returns will be between negative 29.5% and 52.9%. That's what it means. Now let's go to another standard deviation, 20.5% more each. Now the range is negative 50.1% to 73.5%. It means that now this is actually more than 99%. So I'm almost sure, like if you return more than 99% possibility that your return lie between negative 50.1% and 73.5%. So if your returns are normally distributed, we can explain this distribution using the return measure, which is the average, and the risk measure, which is the standard deviation. Now the next topic for this chapter is efficient capital market. Now this type of explanation assumes that the market is efficient. So what it means that if market efficient, then your stock price, any asset price are in equilibrium. Equilibrium status means buyer, seller, they all happy, so there's no incentive to deviate. No move, be fair. It's also called the fair price. How does it happen? We have to have certain condition that the stock price are in perfect equilibrium state, called information efficiency. Information efficiency means that you should be able to get the information at the same time, exactly same time. No faster information, no later. Number 2, every market participant should be able to analyze this information equally. Same ability, same expertise. If it is true, then everybody makes same returns because nobody moves. So no abnormal returns, no excess returns. So it means that, even though the markets are perfectly efficient, investors still make returns, positive returns or negative returns. But everybody has same returns based on the risk they take. You never beat the market. You only get the return based on the risk you take. That's what efficient market hypothesis means. The problem here is we know that information is not perfectly efficient. Somebody have better access to information, such as insider information. Or someone has better technology to get information faster, even though it's public. Someone form a group to rotate, to check the information because people need to eat, people need to sleep, it takes some time to take a rest. So institutional shareholders, investors may be able to access information faster than individuals usually. Number 2, everyone's abilities is different. There exist people who have better expertise in analyzing the market, usually called analysts, right? And star analysts who actually tend to analyze the market more correctly, makes a lot of money, and people buy their analyst report since you can make excess return if you use the report, right? So we know that the market is not really perfectly 100% efficient. And this is kinds of the reaction on the information, new information in efficient or inefficient market. So this solid line assumes the efficient market reaction. So if the value of this information is $40. Okay? Then when this information is announced, it should immediately increase by 40, the value of the information, and just keep the price. That's efficient market. However, we know that there's sometimes people overreact on this news, so increase higher than the value of this information and then get back to the fair price. Or sometimes people delay their reaction, so gradually increase to $180 here. This case is kind of inefficient markets. Long term, like after 8 days here, about a week, market gets efficient, but you actually have opportunity to get the excess returns because those timing markets are not efficient. So there's 3 different forms, like level of the market efficiency: strong, semi-strong, and weak. So we're gonna look at one by one. So first one is the strong form efficiency. Now strong form efficiency assumes that price in the market reflects all information already. So price already reflects all available information, including public and private. So including insiders information. So for example, if somebody insider like you, they know that there will be the very good news announced, say, in 2 weeks, and they start to buy the company stock. However, you never beat the market since the price already reflected. So if it is true that investors cannot make abnormal returns regardless of the information they have. And in fact, we simply know that, right? People use insider information to get excess return and very high return because information symmetry, information efficiency is actually violated, right? So empirical evidence show that the markets are not strong for efficiency. That's why we make insider trading illegal. If you use insider information to trade, and you go to jail. Now, there's another form of efficiency called the semi-strong form efficiency. So now this one, well, there's no way to get the private information together. So let's make it more realistic. Price reflects only all available, publicly available information, including trading information, annual report, press release, any type of macroeconomic measures, things like that. And if it is true that investors cannot make abnormal return by trading on this kind of public information. Okay. And see here, this also assumes that the public information is efficient, right? Information symmetry. But in fact, we know that there are a number of people called the star analysts who analyze market more correctly or better expertise. And they use this type of public information to publish the analyst report and forecast the price. And it's called a fundamental analysis. They do fundamental analysis, and fundamental analysis to analyze all public information, usually including their financial information, any type of news that can affect to the price, and including trading information. And people make excess returns. So, if this market is semi-strongly efficient, then fundamental analysis is useless. But in fact, we know that it is useful. So market is not generally really semi-strongly efficient. There's certain violation of this, the violation of this form of efficiency. However, in the long term, market gets efficient in the semi-strong form. So eventually, they converge the price will converge to the fair price. But in the short term, you may have chance to get the excess return using the fundamental analysis. Now, third form of efficiency is called weak form efficiency. Now, weak form efficiency say that, well, among the public information, there are certain information just regarding on the market. Past market information, price, trading volumes, and usually found in chart, price chart. If it is true that investors cannot make abnormal return by trading on this market information, and number of people analyze, this type of information is called technical analysis. So if market is weak form efficient, then technical analysis will not lead to the abnormal returns. You don't need to buy the book that says, well, if you look at the chart, you can make more money. If market is weak form efficient, then you should not pay the price of that book, right? And then empirical evidence indicates that markets are generally weak form efficient, actually. So I really recommend not to buy this type of book talking about the chart, talking about just the past price to analyze the market. This is graphical representation about the efficient market hypothesis. Now, strong form, broadest, and weak form, narrowest. Now, common misconception about the efficient market hypothesis. Number one, efficient market hypothesis does not mean that you cannot make money. You can still make money, or you can actually lose money too. However, on average, you will make money appropriate for the risk you take. So there's no free lunch. If you expect high returns, you need to take high risk. No excess returns, meaning that the return only given by the risk level you take. And now the third one is now this risk return trade-off. This market efficiency will not protect you from real wrong decision. You have to make a rational decisions, which means that you need to diversify your investment. You should not put all your eggs in one basket so that if you drop it, then you lose everything, right? So you need to diversify the baskets. You probably have to get 10 baskets. Drop one of them, still you save 9 of them, right? So this market efficiency only protects you from your right rational decision. This is the end of chapter 10.